How taxes factor into this equation. When you earn dividends, you're required to pay taxes on those earned dividends, even if you just reinvest them. That's why the type of investment account that you use for dividend investing is extremely important. If you invest through a taxable brokerage account, you'll be paying up to 20% tax for the federal level on your dividends, and there could be additional state taxes owed too. Let's say, for example, you have a $1 million dividend stock portfolio after decades of saving and investing, and you earn a 4% yield on that portfolio in dividends. Well, that would be $40,000 per year in dividends, and if you owed 20% of that in taxes, that's going to be $8,000 per year as your tax bill on those dividends. That means you'd either have to pay that money out of pocket separately, or take that $8,000 out of your portfolio by selling off some assets at the end of each year. But if you want to avoid those taxes entirely, you could invest through an individual retirement account, in particular the Roth IRA. Now, I just did a full Roth IRA tutorial for beginners that I'll put in the corner for later, but let me give you a quick explanation. With a Roth IRA, you can't touch the earnings of the portfolio until the age of 59 and a half, but if you follow that rule, as well as a few other simple rules, your investments grow completely tax-free, including the dividends. So if you're investing for retirement and possibly thinking about using dividends as a source of income later in life, you should really look into this type of retirement account.